Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome. Yeah, technology, right?
I'm not. It's. I think I've been singled out by one of these tech firms to be punished. I don't know what I did. Probably in a former life sometime.
Welcome to another episode of Trends with Benefits. My guest today is Milton Ezrati. He is chief economist for Vested, a communications firm in New York City. He's also a regular contributor to City Journal, Forbes, and the National Interest. And it's also been on Wall Street for a number of years, both at Lord Abbett and Nomura Capital Management. And I'll jump into, hopefully get some time to talk about that as well. But Milton, thanks for joining us.
Thank you. Thank you for your persistence.
Absolutely. You know, one of the things that just stands out, I've got to ask, you're working with Vested as a chief economist, which I really find interesting as a communications firm. What does a chief economist do for a communications firm in that regard?
That's a good question. Actually, when Vested first approached me, I asked the same question. I think the difference between Vested and most communications firms is that they work pretty intimately with all their clients. And the objective is not just to push their client out and get them PR and what communication firms traditionally do. I think that they're trying to help their clients place themselves in the industry and in the general financial economic environment. That's the way Vested does its business. So I think it's the difference between Vested and most communications firms. And I have a role in that integration that they seek.
Does the current environment, economic environment, play into their strategies for communications or their communication strategies?
Well, I think it does. And I mean, it's a wild time we've been going through. And so their particular approach is, I think, particularly attractive to clients who can sometimes feel lost in that environment.
How would you characterize 2022? We've just finished that. We're recording now in 2023. But what was that like for you?
2022 it was a troubled time, obviously. The economy, I think, was on the verge of recession if it wasn't already in recession. It still is. And we had the inflation problem was the big issue, and the Federal Reserve's turn on policy, effectively changing policy for the first time in 10 years. So it has been a time of tremendous change, and 23 will extend that.
Yeah. You know, what are the biggest risks that you see going into 2023 for businesses and or consumers?
Well, it's the same for both, and inflation heads the list. Well, I could say geopolitics, but thank God that's not my bailiwick. But the inflation is the big issue. Inflation such as we've had does not go away overnight. We've had some moderation. A lot of that is because oil and used cars are coming down. They were the cause of the spike before, but the inflation is there. And in fact, and that I think is going to be the big issue. When will the Fed turn? When will the Fed be able to declare victory? It's not coming anytime soon. And I think we can hopefully talk in terms of months if they do their policy right.
I mean, so do you think we're done with inflation?
No, I don't. I think we'll see more inflation. It may not be as bad as it was in June of last year when it hit and when it rose over 9% on a 12-month basis. But I think we will see unacceptable rates of inflation. And there is the basis in that, and this is the danger, you asked about the risks, that we get involved in a wage price spiral where workers are constantly trying to catch up with the cost of living. And because unemployment is low right now, they have some leverage. And managements and firms yield to labor because they think they can raise prices, and inflation gets a life of its own. We saw that in the past, and it can happen again. That is a great danger. Another big issue for 2023 is U.S. relations with China, which were hardly cordial last year, and they're probably going to get more tense as we go through 2023.
And as we speak, it sounds like China is opening up. And wouldn't that help to lower inflation pressures around the globe if they're back or maybe it's the other way around?
Well, it can do both. I don't think it's going to ease the inflation. In the past, China has served as a low-cost place to source things and held inflation down. It is no longer that low cost anymore. The lack of reliability that appeared during the COVID and in the aftermath of COVID, a lot of people are reluctant to source in China anyway. It's not low cost, but if China comes back, uh, and some people talk about it roaring back. I'm a little skeptical of that, but if China comes back, that means raises the demand for energy, and that tends to be inflationary.
And that would just continue to add to the wage pressures and those new drivers of inflation.
Precisely, yes.
Yeah. As I think about this, I always try to look at parallels in history to find any markers of what could happen in the future. Do you see any? Are there any parallels to any other times in history?
That's a very interesting question. I'm always a little wary of this because you start making a parallel and then people start making these rigid parallels. Well, this happened in the fourth year and this is the fourth year. But I would actually draw a parallel to the 1970s, not only because the 70s suffered from inflation, and that's an obvious thing, and they had this same risk of a wage price spiral, but I think the issue in the 70s that was significant is that the United States in that period was losing its preeminence as an economic power. And I'm not suggesting this is permanent, but that is what is happening now. And I think that is a tremendous adjustment for American industry, for American policymakers, and for the world. Comes back to this relations with China. So those two things were happening in the 70s. And in the 70s, it was Japan and OPEC. Now it's China and Europe and the inflation. And I think that's the parallel I would draw. Just turbulent times and uncertainty, tremendous uncertainty.
Would you think that the U.S. is trying to claw back the steering wheel, if you will, from past decades of globalization and this idea of perhaps more onshoring, that we can become the dominant factor again, or perhaps more dominant than we are?
Well, I think the United States is trying. I don't know if it's a power play, as you described it, but the United States is trying. And to some extent, the economics is pushing the onshoring or the reshoring, however you want to talk about that. It is not going to take us back to where we were, both in terms of middle-class employment in manufacturing or our relative power in the world. The United States still is a huge economic power. I think it's a question of perceptions here. We were in the 70s as well. We just didn't know it. And where there's a lot of doubt now, and it's this confidence issue that I think overshadows everything and creates great uncertainty. But I think there will be more reshoring, so to speak. Not a great deal of employment because it'll be done with AI and robots and things like that.
Interesting. You're taking away my trend or fad questions. That's great.
I'm sorry.
It's all good.
It all ties together.
Yeah. And, this question's always asked on financial media. And so I even hate to ask it, but just to kind of get a sense of what you think, the probabilities are in terms of a recession that we might face, this idea of a hard landing or soft landing or a tough recession. Do you have any thoughts on that?
Well, I don't think it's going to be a particularly tough recession. It's been kind of elongated. We've been in kind of a slow motion recession, and I think that will persist at least through the first half of this new year. There's a lot of signs of economic slowing. The one that seems to be contrary is the jobs report. They keep saying, oh, we couldn't be in recession. Look at all the jobs we're creating. But if you look in the details, these people, it's almost as though business were hoarding labor. I can understand why, given the shortages of labor we faced in 21 and early 22, but they're not putting them to work. So what you have is a lot of hours worked, but very little product. And so I think business is very reluctant to let people go and very reluctant to pass over a good candidate. But that can't go on indefinitely. And if they start to adjust, then that recession comes on a little harder in 2023. And if I had to make a forecast, and you're forcing me to, I will say, yes, we're going to have that hard landing in 2023, not a soft landing.
And if you're an investor trying to figure out how to navigate 2023, in your mind, different asset classes that might provide a hedge, if you will, what would those be? The typical, like gold or other commodities?
Well, gold's always been a haven for an inflationary environment. The other thing that's a haven in an inflationary environment, although not immediately, is real estate. We're seeing housing prices fall, but real estate always more than keeps up with inflation. So that might be a haven. I also think the stock market, even though I've been very pessimistic on the economy here, the stock market has been forecasting this recession for over a year now, been adjusting down in jumps. And I think that by the middle of the year, another fearless forecast on my part, by the middle of the year, I think the stock market will start to forecast the recovery. So even though we may be in that hard landing, in the midst of that hard landing, I think stocks might prove to be a useful asset class they look forward, because the market is always looking forward. Bonds, of course, will wait until the Fed is done with its job of raising rates.
Yeah. I've heard some talk about this year might continue to be tougher for stocks, but bonds, now that rates have gone up and now there's a bit of a cushion, even if they both take a hit, bonds will take less of a hit because there's more of a cushion to cushion you.
Certainly in the early part of the year, bonds will be probably perform better than stocks. If the stock market starts anticipating the recovery, it will outpace bonds handily. It always does. But I think bonds have suffered not all the damage they're going to, but most of it. The yields compensate a great deal. They're almost to the point where they are meeting the actuarial standards of pension funds, which makes for a natural buyer. So I think for the first time since '08, bonds may serve as ballast, so to speak, as an investment device. They have been useless until now.
Do you think we're going to return to a sense of normality in capital markets?
I think the normal thing will be that we will not be hovering around zero interest rates. That is not a normal situation, and it distorts capital markets, stocks, bonds, options, everything. If the Fed can settle at higher rates, and I'm not talking about much higher from here, they'll go up and then they'll be able to ease off. That will be an environment that will create a more normal relationship between financial instruments. It'll be easier to navigate, but that's something for maybe 24 or beyond.
And since you talked about it a little earlier, and you've also written about it, the China-U.S. relationships and relations there, what do you think regular investors really need to understand about what plays out there?
I think that the relationship between China and the United States is evolving, and we're not going to return to the way we were. There's a great deal of hostility in Washington toward China, may be justified. The Chinese steal a lot of technology. They have not been forthright in their dealings with us. We maybe have not been forthright in our dealings with them. That relationship is going to evolve. It's also important to realize that wages in China have begun to catch up with those in the United States. And with the reliability issues that came up during COVID and this wage difference being not nearly as vast as it was, I think that we will see more decoupling with China going forward.
Well, Milton, I really do appreciate your time today. And one of the ways that I like to try to wrap up the podcast is ask guests about long-term trends that they see or find really interesting. It could be about what we talked about, or it could be about anything else that just really fascinates you. Do you see anything playing out over the next several years that you're looking forward to?
Well, I think we've seen, we've mentioned AI and the decoupling from China and the reshoring, and I think that will be a real trend going forward. The other thing I think is important is the result of COVID to some extent is that there is a great migration going on within the United States. People are moving to avoid taxes, not evade, avoid taxes in some of the high tax states. They're moving to low tax states. The COVID situation where technology works, you can work from home. And I think that migration is going to change a lot of the way people live and the way we do business in this country. And we've only seen the tip of the iceberg in the years since COVID. So I think that is an important trend. The inflation depends on policy. If the Fed does its job, we can put this behind us by 2024. If they do what they did in the 70s and screw up, then it's going to be with us for a decade.
Something to watch and great insights. Well, thank you very much again for your time. I really appreciate it.
Well, thank you, your time and patience. Thank you very much.
And thank you for tuning in to another episode of Trends with Benefits.